Hello, ladies and gentlemen, and welcome to another installment of Thursday Thoughts. I'm Alex Leonida. I'm also the Chief Investment Officer of Capital Financial Group. And if you guys haven't seen this before, today I am going to share what, at least in my opinion, is the most relevant data and news from this trading week. So I hope you guys enjoy this. I love doing these, and I like sharing a little bit of knowledge every week. If you guys haven't done so already, please like and subscribe, which I don't know where it went. It's supposed to be there. But like and subscribe anyway, so you can get every single one of these videos alerted in your email, and then also you can get updates when we release new information and new content, like Cole's recent CFGU updates, which have been awesome, super valuable information for everybody on core financial planning topics. If you guys have any questions, shoot them over to info@cfgfinancialplanning.com. As always, we are going to cover important data points, the most important ones, at least the ones that I think are important. We're going to get big news stories. We're going to do questions, or in this case, this week, we're going to do one question because it's a really long one. And then I'm going to do my final thought, which you want to stick around for because I'm dropping some bombshells, some knowledge I don't think people are really aware of right now. So try to stick around to the end because it's going to be good. So let's get rolling with our data points. The first one this week, as it has been for the last few weeks in a row, is the most important one, at least in my opinion, and it's the jobs data. Good news on the jobs data. It's not nearly as bad as it was last week, which wasn't as bad as the week before that, and the week before that, etc. We're talking about the blue line here. If you can't read the fine print in the top left corner, this curve looks a little better, right? Things are getting less awful, but we are still over 20% of the entire working population of the United States is unemployed as we live and breathe. And I want to reiterate something from last week that I think is super important, and we'll go back to that chart in just a second, but 70% of Americans that are claiming unemployment right now are actually making more money than they did when they were working. My brother just told me a story about how he just went to one of our favorite restaurants, and he talked to him there, and they're trying to reopen desperately. And every single one of their employees that they furloughed or laid off is making more money on unemployment, and they don't want to come back. They don't even care that the money could go away at some point in the next month or two. I mean, and it's scheduled to go away in July, but they don't even care. They're just like, hey, we'll wait around and see what happens. I mean, think about that for a second. 7 out of 10 unemployed people are making more money sitting on their couch than doing whatever job they were doing before they filed for unemployment. The other thing that's kind of interesting is there are still delays of up to 2 weeks from when people actually file their claims to when they get their first check. So we really don't have the core essence of the data at this point. If we kind of bounce back to this chart real quick, the orange line is bouncing up a little bit again. That's not good. We want that number to go down because that orange line shows continuing claims for unemployment. From our perspective, this is a situation where recipients of the PPP loans were frantically trying to rehire. The guys that were lucky, the guys and gals out there that were lucky and were able to rehire people, that's what gave us that bounce last week. We're not seeing that right now. Like I just said, I mean, we have people failing to rehire their employees, and that's challenging situation for small business owners to deal with. There's a big amendment that passed this week, got through the Congress, and it essentially changes the rules on the PPP loans, and it allows business owners to hire fewer people back and still get their loans forgiven. I'm actually going to go into that quite a bit in the final thought, so stick around for that. I'm going to get into the weeds and talk about how that's going to affect things a little bit. We have payroll data, which kind of dovetails off the jobs data. These are a little bit different because the jobs data that I just showed you is government reported data. Non-farm payrolls is essentially looking at private sector work. Basically, what we see here, this is the epitome of a V bottom. This is good. People want to see this when they're talking about uh, jobs data. I mean, this is saying that things are not nearly as bad as they were last month. The issue we have here is we still almost lost 3 million jobs according to ADP. Um, that is not fantastic. But the good news is it's significantly better than people were expecting. Um, I mean, I couldn't help but think payroll data was going to look better. I mean, it was atrocious. It was the worst we've ever seen since we've been actually tracking this more accurately. I mean, to put it in perspective, things haven't been quite that weird since 1940 in terms of unemployment. I mean, that is a long, long time. The other big data point that Cole mentioned in the Monday Morning Minute, and if you guys don't watch that, you need to because it gives you a heads up for everything that's coming each week. And it's only 1 minute long, like it says in the title. But yeah, it's the PMI data. And the PMI data, most people don't really care about, right? But when you're doing this for a living, you care about the PMI data. And the question you're going to ask yourself is, what is PMI? Well, if you didn't watch last week, I'll kind of do a little quick rehash. It's essentially just an index that summarizes economic activity in the manufacturing sector, which is a huge sector here in the United States. Not as big as it is in some places like Germany, but it's still a really big sector in the United States. And the data we're going to look at this week is basically the big brother or a countrywide view of the data that we looked at on a regional level last week. Just to rehash things real quick, a number above 50 means we're expanding, that's growth. A number below 50 means the economy is contracting, that's bad. So I'm pretty sure you can guess which side of 50 we're on this month. Mm-hmm. Yeah. So not as bad as the last data set, but that seems to be a trend, right? We were in the thick of it last time data was reported, but we're still at 43. I mean, 43 would look good for a terrible economy like Spain or Argentina or something like that. But it's not very good for the US. The bright side of this data is it looks better, right, than last month. And if we get another month of uh, positive growth out of this and we start creeping closer to 50, then that becomes a trend. And when you have a trend reversal, that could potentially mean we have an economic reversal over time. That is a rate of change thing that we've talked about numerous times. And I always get into when I do my really, really long, kind of boring quarterly reviews that everybody should be watching because they're loaded with amazing data. The thing that scares me a little bit is a lot of these subsidies that I just mentioned when I was talking about unemployment, they're going to go away in July unless there's some sort of like major government saving grace, which I kind of talked about how crazy Congress is trying to throw another 3 trillion at everything. That's just my opinion. But these subsidies are likely to go away next month, so it's going to be really important to see how people are spending, what inventory levels look like, et cetera, et cetera. So you guys know the deal. We do 3 data points. We're going to roll into big news right now. Um, Obviously, all the protests, that is dominating the news stream. So people probably have been distracted from some of the economic news or even from some of the news relating to the virus lately. And I think it's important to, at least from what we're trying to accomplish here, to focus back on what is key in building portfolios, understanding macroeconomics, et cetera. Big important news stories that could actually affect you and I from a financial perspective. Not saying that all of this stuff going on with the protests isn't affecting people financially, but you guys know what I'm talking about. So we've been starting with coronavirus data every single week. So we're going to do that again this week. This is the chart you guys are getting used to seeing. The top line is going to be our cases per day. I had to scrunch this a little bit so you can't see that this is actually a relatively good looking chart when push comes to shove. We're making lower highs, and in some cases, a couple of times over the last month or so, that means we're seeing a trend reversal. That's the curve that people are talking about. Things are getting a little bit better. That is real and that is good. Deaths are hospitalizations are the second line here. That curve is good. The reason why this one isn't so zigzaggy and crazy looking is because these people have been hospitalized for a long time, right? So this isn't new hospitalizations every single day. These are people that are still currently in the hospital. So that's why that's a much smoother line. And then last but certainly not least is the deaths per day on the bottom there. Very, very similar trend to what we were seeing in the actual new cases per day. It's promising, seeing far fewer people pass away from this ridiculously horrible illness. That is definitely a promising trend from my perspective. Second up is going to be kind of what I alluded to at the beginning. Congress completely changed the game on the payroll protection loans that they've been arguing about on TV for the last, I don't even know how long. Um, Basically, small business owners are catching a break here. The number or the percentage, essentially, of the loan that has to be spent on payroll is going from 75% down to 60. So this gives them a little bit more flexibility in getting their loan forgiven. So that's good for small business owners, but that could kind of get weird from an unemployment perspective because they don't have to hire as many people back to get this loan forgiven. Um, I don't know. From my perspective, it's kind of a double-edged sword. But the one positive I think that comes out of this is small business owners are kind of the core of the economy. They represent a pretty large portion of GDP, and this provides them more flexibility that they likely need, given the fact that the environment is so incredibly unpredictable right now. The last thing up on the list for big news is actually something you guys probably haven't thought about in an eternity. Here's a blast from the past for you. Brexit. Do you guys remember this? Yeah, that was a thing that nobody talks about anymore. Here's the deal. There is no deal. Okay. As the EU and the UK have resumed their talks over the last couple of weeks, as the coronavirus stuff started to chill out just a little bit over there, one of the things really hasn't changed much. They agree on basically nothing. Nothing. I don't think they've ever been farther apart than they are right now today. I guess it's nighttime over there, so tomorrow for them, whatever. You know what I'm saying. Um, I'll give you a couple of interesting little tidbits here. The UK has openly said that they don't want to follow any of the rules or regulations of the Eurozone. None of them, zero. And then the EU wants to get subsidized advantage trade treatment, and then they also want to get unrestricted access to Britain's fishing waters, which, I mean, I feel like that's kind of a weird thing to be like, hey, I'm just going to fish your waters and there's nothing you can do about it, especially when you're an island. So that's obviously not going well. I mean, when push comes to shove, we're kind of in a situation where they have to hammer out a deal by the end of the month because that's the deadline. If they don't, financial systems are likely going to remain in limbo. And same thing with trade. A lot of uncertainty, a lot of confusion. Businesses have been moving out of London over the last couple of years at a pretty crazy rate. But I mean, if they got a deal hammered out, they likely could attract some of those businesses back. But I mean, really, there's nothing we can do about this right now. I mean, the only thing I can really say is markets don't really care. I'm not sure why. I'm not a savant when it comes to this stuff, but markets just haven't cared since the whole mess started. So even though the deadline's the end of the month, I don't think from a portfolio management strategy standpoint or from a macro view standpoint that you should really care that much because nothing is going to change from what's been going on for the last few years. So those are our highlights from the news this week, and I think that I think the takeaway is that a lot of what we're seeing still creates perpetual uncertainty, and that's different. That's not what markets normally like, even though we're seeing new highs in markets. So keep that in mind when you're thinking about your portfolios moving forward. So now we're going to roll into questions. questions. Actually, this week we're going to do one question. Admittedly, it's a really, really good question, and it comes from a super thoughtful client of ours. And he asked, the PPP and unemployment benefits have kept things afloat for Americans. When these benefits stop and people realize they're not going to get their jobs back, how does this impact the market? Also, how do people redo their risk tolerance analysis with this information so they don't have to take another 20% lump? Um, Unbelievably good question, super well thought out. And I think a lot of the stuff that we've been talking about when we get into data points, et cetera, kind of address this in a roundabout way, but I'm going to get into it, okay? Americans live in the now. I think everybody understands that, right? We're talking paycheck to paycheck, instant gratification. Give it to me now. I want it now. I don't care about the future. You only live once, whatever. FOMO, fear of missing out. Got to be as good as my neighbor. You guys get what I'm saying. Go back and watch the first or second Thursday Thought. I can't really remember exactly, but I talked about how troubling the relief package was going to be from Congress and how challenging it was going to be to get people back to work. If you guys remember, most Americans don't have enough saved in their savings or checking account to cover a $500 emergency in any given month. We're talking $500 of additional disposable income that isn't spoken for with all your debt service or food purchases or whatever, right? So that's kind of where Americans are at right now. So I don't think most people are thinking about what's going to happen a month now or a month from now, let alone next week, right? So I don't know. I don't know what's going to happen. What I can tell you is things are going to get ugly if hiring doesn't improve substantially over the short to intermediate term, because all this stimulus is going away in July. I mean, we've talked about this numerous times, and it's going to be continually challenging to determine where the economy is going to go when we have no idea what's going to happen from an employment perspective. Now, the second part of your question is a little bit trickier to answer because I have to toe the line a little bit from a compliance perspective, but I think I can do a pretty good job without getting in trouble. Ultimately, the experience that we had in March probably should have caused some people to go back and reevaluate their comfort with risk in their portfolio. I mean, a lot of complacent investors were just rolling with it because things were going up and up and up and up for a really long time. And we've only had a couple of blips on the radar over the last 11 years. So people were getting a little bit too complacent. Managing risk is not extremely complicated. It really isn't. And I think it just takes a little bit of patience and a little bit of understanding on how asset classes correlate with each other. If you're in the camp that thinks things are going to get a little bit weird again, and they very well might, I think that you should probably consider being okay with some cash as an asset class. People think about it as like, hey, I can spend money, but they don't realize that cash can be an asset class because inherently it doesn't go up and down with stocks, right? Like, is there any better non-correlating asset than something that does essentially nothing? I don't think so. And the other thing is people need to be okay with bonds. Um, People thought bonds didn't do anything for the last 30 or 40 years. And if you really look at charts, bonds have been in a bull market just like stocks have. I mean, interest rates keep going lower and lower and lower, and people keep making money in bonds. And when things get weird, you want to have some kind of bonds in your portfolio. How much? That's up to you and your financial professional and what your risk tolerance is or whatever. But cash allocation, bond allocation, these are the things that protect people's portfolios, especially if it's really well thought out in times of distress and uncertainty. So hopefully that was helpful for you guys. Also, that was an amazing question, one of the best ones we've had so far. So I would love it if you guys could send in more questions like that so I can get into the weeds just a little bit, because I think it's important. I think it's important to talk about this stuff from time to time, even though it might seem a little bit dry and a little bland. This is my favorite segment of every single episode. It's hard for me to leave it to the end. Like it creeps into every other segment that I do because I want to talk about it so bad. Um, this is my final thought. Okay. Um, and it goes a little like this: income. What is income? And what do you think about when I say that word? I mean, I associate it with a job. Um, some people think about it in terms of investments. For me, both job and possible income from investments, those things are intertwined. It's the nature of the beast, right? But mostly I associate it with a job. Income allows you to pay bills, it allows you to buy things, it allows you to be charitable, all that stuff. Makes sense, right? Um, Here's what's confusing to me, okay? Uh, why has the total disposable income for the United States average household gone up a ton over the last month? I mean, we're not talking like a little bit. I mean, this is massive. Check this out. This is US disposable personal income. This is the aggregate number, or as in all of it together, right? Look at that. Our economy is essentially in shambles. We had a little drop off as everybody started to panic in March, and then boom, the government dumped trillions, the T, into the economy over the last 2 months. I mean, that is nuts. If you look at that right there, we went from 16.5 trillion to over 18.5 trillion of disposable income in the United States in less than 2 months, and the economy is at 20% unemployment. I mean, I'm out here crunching numbers and researching everything, and frankly, this wasn't really on my radar. Like I knew that there was going to be money pumped into the system, right? But this was crazy. I mean, you could be out there, you could make the argument if you really, really wanted to, that it was the government's fault that we lost all these jobs in the first place. So they should be giving us money. I mean, that's not really where I stand on this whole thing, but people can make that argument. Um, people can people can go out there and they can say, "Oh, it was China's fault." China, China, as our president calls it. Um, yeah, it was kind of their fault, maybe. Um, then you have the World Health Organization. Was it their fault? Maybe. I don't know. You get the drift. The point is, how did we get here? How did we get to the point where the U.S. taxpayer is paying for raises for a huge swath of the population? I mean, we've always had social programs. That's not a new thing. We've always had Medicare. Well, not always, but as long as a lot of us have been alive, there's been Social Security, welfare, whatever, right? There's always been the government kind of stepping in to help people who are struggling, whatever. I don't want to get into that today. I'm just saying that's always been there. But this is something completely different than that. This is a whole new ballgame. I mean, where is all the money going? Where's it going? People people are record defaults, right? Record defaults on cars, record defaults and late payments on mortgages. Um, we're seeing consumer debt like credit cards default. Okay, where is this money going? I mean, I can tell you a couple ideas I have. Your local electronics store that I'm not going to name because we're not supposed to talk about stocks is printing money. Home goods stores, not the actual home goods because I don't really know what's going on there, but stores that sell stuff for home improvement or furniture or whatever, printing money. Online sales are breaking the internet, literally, not figuratively, but people aren't paying their bills. This is absolute insanity. I mean, and you and I, and we, the collective we, the taxpayer, we're footing the bill for this thing. I mean, it's craziness. All I can say is this thing is going to come home to roost at some point, and there's nothing the government can do about it. And from a planning perspective and a personal perspective, we need to remain vigilant. Easy for me to say. We need to remain vigilant in our asset management strategies, and also in our personal choices, because the decisions we make every day, they matter. And they matter to what happens tomorrow and the day after that and the month after that and the year after that. So we need to be very thoughtful because we are in incredibly uncertain times. Um, Hopefully the worst is behind us with the coronavirus. I mean, I hope and pray for that almost every day. But hope's not an investment strategy. And it sure as heck doesn't pay the bills. So that's my final thought. And I am so grateful for you guys who stuck around to watch the rest of it. I really am. I love doing these every week. So hopefully you're learning something. Please like and subscribe. There it is. I got it now. Please like and subscribe so you guys don't miss anything. I already mentioned Cole's CFGU videos. They're hugely important when it comes to building a financial base, so watch those. Also, please shoot questions to info@cfgfinancialplanning.com so I can answer those questions for you next week. I'm looking for good ones. Make them as complicated as you can. I love that stuff. All right. Until next week, cheers. Also, you may notice that this is not red wine. That's because it's 80 degrees in my basement, rosé all day, as the kids say. Thank you very much for joining me. See you guys next week.